Welcome, options traders. I wanted to pass on what I think is some really valuable information, especially for all of our new traders who we've had just join us here recently. And that is a little segment that I sometimes call good, better, and best. And what I mean by this is that when you're starting out, that you don't ever want to fall into the trap of thinking that some strategy or some financial asset is somehow better than another, or that one is the best, because that completely misses the point of the financial markets. If a strategy or if an asset has qualities about it that are desirable, it gets priced in. And if it's priced in, it's going to change that risk profile, and it now means you can no longer say it's the best. Instead, it's just different. So the key idea is to understand that there is no such thing as better in the financial markets. No strike is better than another. No expiration date is better than another. Now, I've talked about this before. An easy way to show this is by looking at profit and loss diagrams. So, for example, here is a $100 call in blue compared to shares of stock in red purchased for $100. Now, sometimes people would say that the call option is better because it limits your risk. Well, it's a characteristic of it. But the way you can see is that it's not better is simply from this point right here. This is called a crossover point. And notice that every single point to the right of that the red line or the long stock position sits above the blue. In other words, it outperforms the call option. But if we look to the left of that crossover point, we get the opposite. Now the red line or the long stock position underperforms. And so, again, it just depends on which risks you're willing to take, which ones you're trying to avoid, that should dictate the strategy. What would happen if we compared a bond to an option? Same thing. Here's a bond that pays off, let's say, $10 at maturity compared to that $100 call. So the bond has no risk. It's a flat line. It always pays off $10 at maturity. But it's limited. So again, we've got a crossover point, everything to the right. In this case, that the call option wins, and everything to the left, the bond outperforms. So why am I making such a big deal of this? Well, it is a rampant error. And somebody just sent this to me the other day from Quora, which is a website that is supposedly for sharing knowledge. And somebody had asked about debit spreads. And here was this person's response. And if you look right down here, he says that debit spreads are preferred as they can be better adjusted. Well, there's that word better again. You don't want to fall into that. Why is this absolutely false? Well, let's look at the debit versus the credit spread. On the left, I've got the 100-105 debit spread. We're buying the $100 call and selling the 105 call. Well, the trader on the opposite side of that is going to have the credit spread. He'll be short the 100 call and long the 105. So that person on that post there is saying that the debit spread is preferred because I can easily morph it by just simply closing out this 105 call and be left with a 100 call. Well, look at the one on the right. I could just as easily close out the short 100 call and be left with a 105. Is one better? No. One person's left with a long 100 call, one person's left with a long 105. They're just different. So if we look at the 100-105 debit spread, another difference is that trader is morphing from the blue to the red. He's going from a limited bullish position in blue to an unlimited bullish position in red. But again, we've got a crossover point. I can't even say that the morph is better. It just changes the risk profile. But what about the person who morphed the credit spread? Well, he went from a limited bearish position in blue to an unlimited bullish position in red. So, is it better to go from bullish to bullish or from bearish to bullish? Impossible to say. Depends on what you're trying to do. In this case, maybe we're bumping up against resistance. We think it might fall. We take the bearish side, but if it breaks out, we want to flip to the bullish. Now I'd prefer to have the credit spread. Let's take a look at the two different morphs independently. The debit spread morphed to the $100 call here in red. The credit spread could morph to the 105 call in blue. Look at this. Crossover point. I cannot say that one is better than another. So I've tried to emphasize this till I'm blue in the face. And no matter how many times I say it, somebody is always out there saying, this one is better, this is the one that you want to do, or avoid this one, and they are simply not true. So if you're going to succeed with investing, and especially with options, get away from thinking of the terms good, better, and best. Instead, think the word different. And when you can find out what the differences are and how they apply to you and which is best for you, that's when you're going to succeed. And for those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, there are some mini courses, such as the Greeks and volatility, for those who may be interested in specific topics. And we'd love to have you join us on the Facebook trading group Options A to Z, and you can find a link in the description below.